Welcome to Stifel's Sightlines podcast, focusing each week on a topic or two important to investors.
Well, greetings and welcome to the Sightlines podcast. This is Michael O'Keefe, Stifel's Chief Investment Officer. In this episode, I want to get into really two interrelated topics. One is the potential for peace in the Middle East, what's been happening there. And then two is really the impact on the Fed, but also I'll make mention of the results of the first Fed meeting after Kevin Warsh has taken the role as chair. There were a couple little changes that I think are worth noting. And of course, the two things are interrelated. So let's jump in. You know, when we go back to the beginning of this conflict almost 4 months ago, it was fast moving, right? It hit the Strait of Hormuz, essentially closed really quickly. Oil prices jumped up, markets reacted. They've come back since then. But just to try to make sense of it, like we sometimes do, we laid out in an article essentially four possible paths that could unfold, ranging from really dangerous escalation and a broadening of the conflict to the potential for durable peace. And the scenario, anyway, that seems to be taking shape is the one we called managed off-ramp, a negotiated conditional de-escalation. And so that's where we are. And specifically, the U.S. and Iran have agreed to a framework that essentially extends the ceasefire, reopens the strait, lifts the naval blockade, et cetera. And so markets reacted quickly to that, understandably. The oil prices fell. The equity markets pushed up a little bit. So inflation expectations as well, as you might appreciate, have softened. And so let's jump into a little bit of the data, and then we'll shift and talk about sort of the influence on the Fed and what's going on there. So ultimately, remember that about a fifth of the world's oil and liquid natural gas flows through the strait in normal times. That's been essentially at a standstill during the conflict. And so the framework is going to extend the ceasefire for 60 days. And then it'll take a time for shipping and production to kind of rebuild. But essentially, oil prices fell a little bit, think in the neighborhood of 4 to 5%. And it's down, by the way, about 20% from its peak. And I think people have been anticipating this possibility. So oil prices have fallen a little bit. They're still well above, of course, where they were before the conflict started. We had set for WTI a price of $70, still a little above where it was before, but as a reasonable price to kind of monitor for. And essentially, it's around 81 right now. Futures are forecasting that we'll get back to 70 towards the latter half of 2027. But just to explain, up until this agreement, that date was much further out, right? So the market's now pricing in confidence, reasonable confidence that this is going to stick. And so that's pretty important. Now, the other thing, this number is quite dramatic. The 1 year break even, so inflation expectations, hit 5.4% in March. So that was the market saying, oh my goodness, with this change and the shutdown of oil prices going up, et cetera, the market was pricing from that moment an inflation rate of 5.4% basically in March for the coming year. That break-even rate from today forward is down to 2%. Of course, that's the Fed's 2% target, and or right at the Fed's 2% target. And so, again, I think that of all the things we're looking at, certainly oil coming down is good, but that the idea here is to see if inflation can come under control, and the market's signaling that's a pretty strong possibility. Excuse me. Now, markets were up. Think of it just up about 1%, although Asia, Korea, and Japan up a bit more than that. Think rough numbers, middle single digits, like 5 or so percent. But I would say, other factors influence equities, right? There's sort of this sense that AI may be a little bit overdone in terms of pricing on stocks and things like that. And then I'd also say, too, that the market interest rate, most notably quoted, the 10-year Treasury yield has fallen just a little bit, but really almost unchanged. in the wake of this. And what that reminds us, and we talked about it in the last episode, that there are other forces at work keeping rates higher. Among them, the fiscal trajectory of U.S. government debt and the U.S. government and the buildup of government debt. And so we have to be mindful that the market's not going to quickly react on the rates perspective to this in isolation, right? There are other forces at work. Now, that idea that inflation may come down, that's a really helpful thing to the Federal Reserve. And as I mentioned, we've had just this week, our first meeting under the leadership of Kevin Warsh. And there are a couple of interesting things that happened. The first is, number one, policy rate is unchanged. It was a unanimous vote, which is good to see, right? Negotiation, discussion, debate, blah, blah, blah. And then they all agreed to, move forward in that way. Number two is that under Warsh, the statement, which the Fed is super methodical about changing, like it's almost like an optimization problem. Let's change the statement as little as possible to reflect what went on in this meeting. And it was always a fairly lengthy statement. But basically under Warsh, it came out as a very short, very direct, very clear statement about policy. But what they kind of took out was any kind of signal about what might be happening down the road, right? And I would say also in the statement, they reinforced very definitively their focus on prices and inflation, and basically that they're going to get that under control. You could see that signal in what was this short statement. Now, they also issued their summary of economic projections. We'll probably get into that in a little detail in another episode. But remember, what that is a survey of all the Fed officials providing their view looking forward. Warsh, probably as a statement, didn't participate in that survey. So his view is that's too much. And so anyway, how's he going to make a mark? Well, what he announced in his first press conference was a task force. And essentially it's five different tracks of work that he's going to have both internal Fed and external experts work together with really what I heard from the press conference was roughly getting work done by the end of the year, which is, in government terms, pretty darn quick. But ultimately, the five tracks are Fed communication. How does the Fed communicate? Number two, what's the right use of the balance sheet? Number three, what's the right use of data? Like what data should they be looking at? Number four, interestingly, is productivity, the productivity of jobs. And then finally, basically, inflation and different frameworks and probably ways to measure inflation. So again, we'll learn more and probably do another episode to dive deep into this. But that was interesting. It was sort of like he came out very confidently, very definite. Shorter statement, didn't participate in the survey, and launched a task force with 5 tracks of work. I will say too, and I found it comforting. He's a very bright and articulate person. And so the press conference, I thought, was extremely well executed. His statement before taking questions was extremely good. And, at the end of the day, we'll see how things unfold. But from my perspective, just in terms of having confidence in the institution, that they remain sort of apolitical and focused on their dual mandate, my confidence was reinforced as a result of these meetings. So I hope that's a little bit helpful. Anyway, hey, that's what we wanted to get into. We'll all look forward, hopefully, to more details and more execution on this peace deal, more understanding of what's going on with the Fed, and in the end, how that all affects all of us, both in terms of our lives day to day, but also the markets. We really appreciate you taking the time to listen to these podcast episodes, and we'll look forward to catching you on the next one. Thanks so much.
Thanks again for listening to Stifel's Sightlines. Be sure to subscribe wherever you're listening to automatically receive each week's podcast in your feed.